Hey there, everybody out there. Whew. Those of you that are just joining in or rewatching. Hello, Alice. Hello, Catherine. What's everybody doing? Super excited for this conversation. Matt Adler is an amazing mortgage broker. And hey there, Matt. Matt, so you are going to want to request to go live. And then we can get started. Garrett, thanks for joining. Hey, Matt. Is there a button that says request to go live? That's what you want to click. Hey, everyone. Just trying to figure out the technology right at this minute. Okay, let me see. I think I can choose. I can send an invite. Let's see what's happening. There we go. Okay, Matt, I'm sending you, I must have changed the app since the last time. I'm sending you the request to go live with me, so watch out for that. There we go. Hey there.
Hey.
How's it going?
Good. Sorry,
Good.
I have to switch devices to get it to work. So let me just get paired up here.
Cool.
Yeah.
Well, we've got some familiar people in the audience here.
I saw some names I recognized. Yeah.
So great. Thanks so much for doing this.
Thanks for having me. Let me just try to get your face on here.
All right. Technology, we love it. We're going to bring Matt back on here. And just remind you, if you have any questions, put them in the chat. I will make sure we work them in. So you can, I'll write them down. So you can do it now or you can do it later. I'm going to be talking to Matt about a whole bunch of stuff. All right, bringing him in again. Second time is a charm.
There we go.
Good?
Much better. Yeah.
Okay, awesome. Great. Well, let's start by you introducing yourself and who you are and who you work for and what you do and all of that.
Yeah. So I'm Matt Adler. I'm a mortgage loan officer at Lake Michigan Credit Union. Been with the credit union since 2014. Been doing mortgages since 2003, if memory serves. So we help people buy, refinance, build, renovate houses, condos. And my dog's joining in as well.
They have perfect timing.
Yeah, gotta love it.
Cool. So I've known you for like at least 10 years.
Mm-hmm.
We've been working together. So it's always nice to have really long, trusted history with somebody.
Absolutely.
All right. Well, let's just jump right into it. I think I'd like to start with as far as like a mortgage, so how a mortgage loan officer, mortgage broker, like how do you choose one? How do you choose which bank to go to? Like what kinds of questions should you be asking when you are looking to find somebody to help you with a mortgage?
Well, that's a great question. I think first and foremost, you want to try to work with loan officer that understands your wants and your needs. But you also need to work with a lender that has the different programs that can suit you. because not every lender, not every institution has the same options to work with. The options are a bit more narrow now than they were 15 years ago, but still you'll go to a bank or a credit union if you want certain type of products that only they offer. You might want to go to a broker if you want to kind of look at a different set of options as well. So my analogy when I'm talking to clients is you want to go to a really great hospital, but you want to work with the best surgeon you can as well, and making sure that they really understand why you're having the surgery to begin with.
Okay. And so, so can you just explain like a little bit, like, because you're a loan officer for
Mm-hmm.
a company, and so a mortgage broker can offer loans from, 100 different companies or something like that, depending
Right.
on, but you don't really have maybe the visibility about the organization itself. It's more the person than the person and the organization. Do I have that correct?
Yeah. So the broker is going to they can work with however many different investors that they particularly work with. They could choose to take your loan to Quicken, or they could take you to United Wholesale Mortgage if you're just talking about like local institutions,
Mm-hmm.
or they can look at an investor in California. So maybe you've got some off the wall scenario that only one investor would take. A broker would be a really good place to go to. The downside, though, is that relationship you create with the broker, it kind of ends at the closing table because they're not keeping the loan. It goes to a
Mm-hmm.
different financial institution. So you have an issue, you have a problem, you have a question. That broker could be the nicest person in the world, but they're not going to be equipped to necessarily help you. And they may not necessarily know the underwriters or management or different people who are making the decisions on the loans for the different institutions, because they're working with a wider net of institutions as opposed to just narrow individuals that they work with day in and day out. The bank, the local lender, the credit union, they're only offering their own products, but that's what they offer, and they know it well, and they know everybody up and down in between, from the processor to the underwriter, and that's all they work with. So maybe a little bit of a different rapport. And then also, if you have an issue and that lender is still servicing the loan, they may be equipped to help you fix an issue after closing.
So a little bit more of a personal experience working
It,
with
it can be, or at
loan.
least longer term.
Right.
Yeah.
Okay. So let's talk about different types of loans. So there's the conventional FHA, VA, things like that. But then you also have some different products as well. Can you
Mm-hmm.
get into a little just about the variety and any special programs that are specific to like Michigan Credit Union?
Yeah, so you're right. You've got conventional Fannie Mae, Freddie Mac, quasi-government agencies that do about 70% of the mortgages in the nation. A little bit more credit score sensitive, but kind of like the gold standard. Sellers love conventional buyers because they have a little bit less to worry about, especially when it comes to the appraisal. FHA, VA, USDA, rural development, those are government-backed loans, usually really good for credit score issues, job hoppers, high debt to income. So a little bit of a riskier borrower to a certain extent. That's for FHA. In VA, I'm not going to say it's a riskier borrower, but a little bit less constraints when it comes to credit score and debt to income ratio. But those options are great for first-time home buyers, limited down payment. USDA Rural Development, also zero down option government, kind of runs very similar to FHA. Then you start to talk about portfolio loans. So the Fannie Mae, the Freddie Mac, the conventional FHA, VA, those are loans that are based off of guidelines set by these institutions. A portfolio loan is the lender saying, we're going to make our own program based off our own rules. We're not relying on somebody else to say what a good loan is and what a good borrower is, and we'll keep the loan. We can't sell it like we may be able to in other scenarios. So some of the special products that we do that's portfolio that we're not selling, that's not going to be conventional, things like that, would be the ability to finance condos that may be a little bit outside of what Fannie Mae and Freddie Mac and FHA would look for. Special loans for doctors, and dentists who to put no down payment, or special loans for nurses or CPAs or community experts with lower down payments, loans to build homes, loans to renovate homes, loans to buy just land.
Oh, okay, so you do land loans as well.
We do land loans as well, yeah.
Okay. So we have our first question that came in from Sabra. Thank you,
Mm-hmm.
Sabra. So she wants to know what is an FHA spot approval, and does it make FHA certification irrelevant when it comes to condo developments?
I don't think it makes it irrelevant, but in 2010, FHA changed the rules on condos. Because when you're buying a condo, the lender not only has to look at the borrower, their credit, their income, their assets, their employment, but they also have to look at the condo they're buying, because they're buying in a community. So what's the financials look like for the condo? Are they setting aside the right amount of rainy day money? Do they have the right type of insurance? How many people are renting versus owning the units in the condo complex? There's rules for all these with the different mortgage programs that exist. And in 2010, FHA said, we're not going to let individual lenders review and approve these specific things. We want the condos to request approval from us, and we'll approve them for several years, and we'll keep track of the number of FHA loans in those condos. A couple years ago, because that was a little tough to navigate, because not every condo association was willing to try to get FHA approval for the project. So a couple years ago, FHA brought back spot approval, or single unit condo approval, as it's kind of formally called, to say even if the condo is not approved by FHA as a whole, FHA will look at that individual unit, that individual transaction, for just a one-time exception.
So I know with VA, if you get the condo approved for a VA loan, it makes the
Mm-hmm.
whole development approved, right? So
Yep.
that's different than FHA. They just approve one, and then you would either have to get the whole complex approved after that, or just continue to do spot approvals.
You could still have, they're kind of independent. You can have the whole condo complex approved, but if it's not approved, you can do the spot approval.
Okay.
And if you do a spot approval now, that doesn't mean you can't do another spot approval later, or you can't try to get the project approved. Before FHA made all these changes in 2010, they didn't really have a way to keep track of how many condos they were doing in project. And they got a little bit worried with some condos that started to lose values, that maybe they had too much of a concentration in there. So part of their goal with the project approval is to limit how many units in a project they'll do. With spot approval, they are keeping better track than they ever had, to still try to make sure that they don't exceed their maximum concentration in the project. So spot approval, what it's done is it's opened FHA back up into condos that maybe wouldn't have been an option before, just because you didn't have the participation of the association to get project approval. And all we have to do for the spot approvals, we have to look at the condos master deeds and bylaws. So the master deed kind of defines the units and how many buildings, and gives you an idea of what the plan was in building the condos. And the bylaws just govern the rules of how you can live there and how you maintain it. And we look at the budget, and then we review it and approve it. And if we like it, we send it to FHA for an approval. And it takes about a week overall, start to finish, once we have all the documents. And then FHA says, yep, this is good, or no, it's not. But usually if we send it off to them, we know it's okay. And then you go on with the normal transaction, order an appraisal, and try to get the buyer closed.
Okay, we have a couple more questions coming in about FHA. So Jessica wants to know, is there a benefit of doing FHA if the buyer can afford more than the minimum down payment, which is for FHA 3.5%? Are there other benefits besides just the low down payment?
There are. You can do a conventional with 3% down. So that's a lower down payment than FHA. Where FHA excels over conventional would be if you have lower than ideal credit. So credit scores in the 600s. You can still get a conventional loan with 600, but conventional's interest rate is going to get impacted by that credit score. And the PMI, the private mortgage insurance that you're going to pay on a conventional loan, is going to be more expensive the lower your credit score is. FHA is a little bit more credit score ambivalent. So if I have a 620 credit score with FHA, I'm going to get pretty much as good of a rate as I would with a 700 credit score. Today, it's going to be something below 3%. If you try to get a conventional loan with a 620 credit score, you're going to be considerably higher than that. So FHA is going to be really great when it comes to interest rate and PMI with the lower credit scores. FHA is going to be also pretty good if you're a job hopper, or if you're trying to increase your buying power beyond what conventional would allow. The debt to income ratio. Debt to income ratio says, how much can you borrow? How much is the measurement of your monthly payments on your credit report and the mortgage payment compared to your gross monthly income?
So just to interrupt you there about debt to income ratio. So if you can just give us like a quick and dirty calculation, like if somebody is saying, I'm thinking about buying a house, like based on, what for FHA or conventional, if I make $4,000 a month, like how much debt can I carry to be able to be approved?
You're making me do math in my head.
Oh,
hang on.
Well, maybe just tell us the percentage. Then.
I can calculate right here. I got a computer. It's wonderful. So if I've got a $4,000 a month income, and I'm looking at conventional, the debt to income ratio is 45%, with some exceptions, but we'll just say that for now. So that means $1,800. I can have whatever's on my credit report. If I've got a car payment of $250 and I've got credit cards of another $100, that means I've got $1,450 that I can budget for my mortgage. Principal, interest, taxes, insurance, mortgage insurance, and association dues. Now, how much of a mortgage that translates to is going to depend on those variables, but probably something to the tune of $180,000 mortgage. FHA will go to 55%. So I've got another $400 that I can use toward my mortgage. That's another $80,000 of buying power. So that's another big difference between FHA and conventional.
Okay. So we had some questions that come in to talk about, Simon wanted to know about the MSHDA down payment assistance.
Okay.
And then Sabra, and so I think these kind of go together, or other incentives for first-time home buyers and such. What do you have access to?
So MSHDA is an awesome program. That's a state of Michigan program that we participate in. It lets a buyer buy with 1% down. They get $7,500 that helps them pay the rest of their down payment. So if we're talking FHA, 3.5% down payment, I have a 1% down from me. MSHDA covers 2.5%. And with conventional, 3% down payment, so I put 1% down, MSHDA covers 2%. And then whatever money we didn't use for the down payment of my $7,500 assistance helps pay closing costs. So in a lot of situations, I'm only putting 1% down, and MSHDA is covering the rest of my down payment and closing costs. So it's less than a security deposit if I were to rent.
So, and then that is a forgivable loan, or you have to live in the house for a certain number of years for it to be forgivable, or or do you have to just pay it off? You don't make payments on it, but then you have to pay it off when you sell. How does that work?
The current version of the program, that $7,500 is never forgiven. It's gonna sit there. You're not making monthly payments on it. Interest is not accruing, but the $7,500 is there. So at some point in the future, when I hit the lotto, when I pay off my mortgage, or if I sell, it gets paid off. But because there's no interest and no payments, it's like a zero interest loan.
Can you refinance your loan and keep your down payment, or do you have to pay it off when you refinance?
It gets paid off when you refi.
You have to pay it off.
You do have to pay it off. Yep, it gets paid off with the mortgage. It can't separate from the mortgage.
Okay, so it can't be like subordinated to a new mortgage or anything like that.
No.
Okay.
Not the current program. There were other programs in which they had in the past that did that.
Okay. Are there certain eligibilities for like who can qualify for a down payment assistance?
So with MSHDA, there's some qualifications. If you're buying in what's called the non-targeted area, you have to be a first-time home buyer, meaning not own a home in the last 3 years. So I could have owned a home before, but if I sold it, if I lost it in foreclosure, as long as 36 months passed, I'm eligible. There's income limits. Those income limits depend on the number of people in the household. So it's one set of income limits from 1 to 2 people. It's a little bit more income for 3 or more people. Now, if I'm in a target area, the income limits are a little bit
Is
higher.
that is what, like a low to moderate income census tract? Is that how you figure that
It would
out?
be, yeah. Michigan has a whole
Okay.
table. Every year they could
Okay.
reevaluate
So
it.
it's
So,
different.
like
Okay.
Detroit is one, Pontiac, Southfield, Dearborn. There's a lot. In some counties, some entire
So it's
counties
not
are.
so it's not parts of Detroit. It's city by city.
Mm-hmm. It's all city by city.
Okay.
Yep.
Okay. Okay. Let's see. So Sabra had another question. This goes back to debt to income ratio.
Mm-hmm.
If you own a property and you want to buy a second one, let's say, and you like to move into, can you rent out the property that you were in and have the rent count as income or not count towards your debt?
A lot of programs will let you. Some of them will let you if you have a certain amount of equity. So FHA is a little bit less lenient in this example. Conventional is easier. If you don't have a history of renting out properties, at best, it can wash out your current mortgage payment, meaning it won't hurt your debt to income ratio. What you can't do unless you have a history of renting out properties is use it as wiping out your debt to income ratio and as additional income.
Okay, got it. It's one or the other.
Mm-hmm.
Okay. So let's flip and talk about investors for a moment. So if somebody
Mm-hmm.
wanted to buy an investment property, how much would they have to be put down? Is it 20%? Are there situations where it's not 20%? Or what are the requirements?
Depends on the property type. So a single family property, a condo, that's the lowest down payment possible. That's going to be 15% down.
Oh, wow. I thought that for investments, you had to put 20% down. That's pretty cool.
Yeah, you can do 15. Now you will have PMI
Okay.
because you're left less than 20% down. So there would be private mortgage insurance, and this is conventional loan because FHA doesn't do investments. Now, if it's a 2 to 4 unit, then you're putting down 25%. And then if it's 5 units or more, that's a commercial loan. So we wouldn't be able to help with that.
Okay. All right. That's good to know. Is there, are there any like special loan programs for investors, or it's just conventional, or maybe portfolio?
It's conventional, it's portfolio, it's also renovation loans if you want to buy and rehab a property.
Oh, so you do renovation for investors as well. That's really cool.
We do.
Okay. That's great to know. Okay. We had another question from Sabra. So the whole idea of a non-warrantable condominium is when like you said, you're not only looking at the borrower and if they're financially qualified to buy, but you're also looking at the condo association to determine if it has the proper, it checks all the boxes for what, you're looking for. So her question was specifically about the number of renters to owners. Like what is the limit for something to be warrantable?
It really depends on if you're buying it to rent out or you're buying it to live in it.
Okay.
Because technically, if you're buying to live in it, there's not a limit for rented out units.
Really?
Yeah,
okay.
The rented out units only matters if you yourself are buying it as a second home or a rental.
Okay, interesting. I thought I knew so much and I know so little.
Yeah. Now there could be an issue if there's one person or one entity that has too many of those units. That's a little bit of a different story. It kind of goes back to how FHA doesn't want to control too many units in a project in case there's a problem with values. They want to say the same thing where if one person has a financial disaster and has to liquidate all their units, it hurts all the values of the project.
So just to reiterate, if I have a condo complex with 10 units and 8 of them are occupied by renters and I want to move into one of them, that is still warrantable loan.
As long as everything else, all the other boxes are checked.
All the other boxes are checked. Wow. Yeah. Had no idea. This is blowing my mind right now. So this is a really good to know.
And non-warrantable doesn't mean it's a bad condo. It doesn't mean if there's anything wrong. It is what it is.
This doesn't check the boxes for Fannie and Freddie,
Right.
basically. Okay.
Like there's one thing that always drives me nuts is if there are two buildings planned to be built and the developer who is planning on building it never built the second building, that is never going to be a warrantable condo because you can't be warrantable if the whole project isn't complete.
Mm-hmm.
So how you fix that is the owners would need to get together and change the master deed and
Do an
get some
amendment.
attorneys together and they
Mm-hmm.
amend it and say,
Yeah.
no, we're never going to build this second building. But until that happens, it's going to be non-warrantable, even
Mhm.
if they're doing everything else right with the
Yeah.
condo association.
Okay. That's good to know. So I want to talk about duplexes because I
Hmm.
think we have a lot of people who, both investors and owner occupants, who like the idea of buying a duplex. So
Hmm.
for conventional down payment, owner occupied is 15%, and then it's 25% for an investor. Do I have that right?
It is. Now there's exceptions to every rule. So if you're low to moderate income yourself, and
Okay.
that amount varies based on the area, and you don't own you don't own a primary residence, and for the most part, you don't own any other real estate. There is a way to get by with 5% down on a duplex,
Okay.
um, but otherwise, you've got the numbers right.
So
15, 25.
So the borrower themselves has to be low to moderate income, or it just has to be in a specific area, or both?
The borrower has to be low to moderate to the area.
Oh, I see what you're saying. Okay, so it depends on the area, how their
Mhm.
income compares to the area. Okay,
Correct.
that's good to know. And then FHA, you could still do 3.5% for a 2, 3, 4 unit.
Hmm. Yep. But
Okay,
you've got to live in it.
right, of
You've got to
course.
live in one of the units.
Yeah. And so I think what comes up, especially in Detroit with a lot of duplexes and multifamily homes, is
Hmm.
FHA has some condition requirements. I know, like peeling paint, um, trip hazards in concrete, things like that. Um, what other things, like what about like asbestos wrapped pipes? Would that be something that would come up?
It probably would.
Okay.
Um, FHA has their rules of what they want the appraiser to see, but the appraiser's not there for very long. If it's something that's obvious in the photos that they take, they'll bring it up. If
Mm-hmm.
they don't immediately see it, and you've been probably present for more appraisals than I have, but they're very long, like a home
Mm-hmm.
inspector would be. So if it's not immediately present that they can see or they can remember or they can comes up in the photos, they won't bring it up.
Okay.
But like with any mortgage, it has to be habitable. So it has to have working utilities. It has to have electricity that works, so a heating source, a water
Mm-hmm.
source. The toilets have to flush. If you don't pass one of those elements, FHA or not, you may have to do a repair before closing or look at a renovation loan.
Okay. Can is there renovation loans? Are there renovation loans for with low down payments, like 3.5% or something like that?
So you could do a renovation loan for a single family with 3% down on a conventional renovation loan.
Okay.
There's an FHA renovation loan called a 203K or a
Mhm.
streamlined 203K that would allow for 3.5% down, owner occupied.
Okay. Okay, that's good. So your Lake Michigan does the 203Ks as well.
We don't do 203K
Okay.
because we do a lot with other renovation and construction products. We don't do it with the FHA ones though.
Okay. Just to go back to the question about limit to the number of renters in
Hmm.
a complex. So Renee has a question here. She was trying to sell her condo to her renter, and the renter got feedback from the lending institution that there were too many renters in the complex and it was too risky. So
Hmm.
that doesn't sound like a warrantability issue. Could that be like an FHA, more like an FHA issue or something like that?
There are some lenders that interpret warrantability a little differently
Okay.
because Fannie Mae and Freddie Mac leave it up to the individual lender to determine. So I have heard that some lenders have made their own maybe overlays, which are different additional rules, more restrictive than what Fannie Mae or Freddie Mac would allow for things like that.
Mm-hmm.
Also, if push came to shove, there are exceptions you can request from Freddie Mac for warrantability. So that's something where we said they don't look. It's not about you. It's about the condo. That's something that the borrower's strengths would come into play to potentially overcome minor warrantability issues and still get a warrantable mortgage.
Okay. Um, so let's see. Simon has a question about rehab costs. So can you
Mm-hmm.
walk us through like when you get a rehab loan, how that works, like what the
Yeah.
process is to get it, and then how the funds sort of get distributed?
So we'll talk about a rehab purchase because you can do a rehab with a refinance too if you already own the property or
Okay.
you bought it cash and something like
I
that.
think I think yeah, maybe purchase is more relevant.
So you're going to start off with a purchase agreement to buy the property. You need to define how much that price is going to be. Next, you need to identify the repairs. And when it comes to repairs, there's wants and there's needs. So the needs are the things that need to bring it up to code or habitability, like we talked about earlier. And then the wants would be the frills on top.
Mm-hmm.
And then you need to get a bid. So you would present your lender with the purchase agreement to buy and the bid for the work that you want to have performed, and it has to be professionally bidded out from a licensed, insured contractor or builder.
Mm-hmm.
Then the lender orders an appraisal, and unlike a non-renovation loan, with a renovation loan, we're going to ask the appraiser what the home would be worth with the renovations. We don't care what it's worth now.
Okay.
Today's value is irrelevant. What it will be is what matters.
Okay.
So we can lend up to 97% of the cost to buy and renovate. And once the appraisal is received, then we'll approve the buyer, and then you'll close. At closing, the seller gets paid, so they're out of the equation. The property is yours. And then your contractor starts to do the work. And when they do the work, they're going to ask for money because they want to get paid, and they can usually get some money up front to get them started. But everything else is a reimbursement style draw is what it's called. So the contractor says, I need to get paid for X, Y, and Z items. The appraiser goes out to confirm X, Y, Z is done, and the contractor gets paid. So depending upon your scope of work, that could happen 2-3 times. And then the contractor gets their final payment, they're done, and you move on with the next 15 or 30 years of your life.
Okay. Does the lender have to like make sure that all the permits were signed off on, or is there anything else just besides visually confirming that the work is done to let that final payment go?
The lender will want a copy of the permit, yeah.
Mm-hmm.
And there's also another party involved, the title company.
Mm-hmm.
When you buy a home, a title company is making sure that you're getting the home free and clear of any liens. But when any contractor does work on a home, they could potentially lien the home. Because if you don't pay them, they want to receive their money somehow, they put a lien on. So the title company is going to do a title endorsement at every draw, just confirming, hey, nothing's been liened, everything appears to be paid on time. So they give a thumbs up. So there's the visual confirmation from the appraiser, there's the confirmation from the title company that there's no liens, and then we'll give the buyer an opportunity if they want to sign off on each draw, they'll have that option to do so too.
Okay.
Then we oversee all of it.
Okay. So you have somebody that goes out and does the inspections from.
The appraiser does.
Okay.
The appraiser is a construction inspector essentially in that position.
All right. Interesting. And so does that lending process take longer than a regular conventional purchase or something like that?
In an ideal world, no. But it just depends on how quickly it takes you to get your bid. Because I can't order an appraisal without a bid.
Mm-hmm.
And these days, it is hard to get a contractor's attention. So if it takes you a little bit of time to get the bid, that's going to push the timeline back a bit.
Mm-hmm. Okay. So maybe have to tack on like an extra couple weeks
Potentially.
to the 45 days. Yes. How true it is that it's hard to get a contractor's attention.
Mm-hmm.
For sure. So as far as timing goes, when is like best case scenario to start working with a lender? Like if you want to buy a house in 6 months, like what's do you encourage people to, what's best practice?
As soon as you decide when you want to buy and that you want to buy, then.
Mm-hmm.
Because it's always a good idea to game plan. We've got access to so many different credit scores these days. You can get your credit score on, almost any app you go to, and you can get it for free. But the
Mm-hmm.
scores that you get online are not the same scores that we use as lenders. There's about just shy of 30 different ways to calculate a credit score, and they're all FICO scores, but
Okay.
they're not all the same FICO scores we use, and they have different highs and lows. So a 700 with one score model is different meaning than a 700 on another. So it's a good idea to get your credit pulled by a lender right away, talk to a lender, calculate what your debt to income ratio looks like now, what's your buying power right now. And if you're not satisfied with that, what do you need to do to improve things? A pre-approval can typically last with most lenders 90 days. We're 120 days. So that one credit pull could be good for 4 months. If you found a home right away, that might be the only pull you need. And maybe you get a great score, but maybe you don't. And you surprise yourself, and the lender can tell you, here's what you need to do to fix things.
Okay. And I just lost my question, but I'll go to one of Sabra's. So,
Mhm.
how is so the difference between a pre-qualification and a pre-approval? If you could discuss that.
Mhm.
Her question was more specifically, is Lake Michigan's pre-approval different than Joe Schmo mortgage broker?
So a pre-qualification is tell me how much you make. A pre-approval is show me how much you make. So the pre-approval is give me documentation to prove your employment, income, and assets that you told me over the phone. Both involve a credit pull, typically, but one is just a little bit more thorough than the other.
And how long does it take to have your documents reviewed if you wanted to get the full pre-approval?
If you're not self-employed, if you don't have a bunch of rental properties, you just you have a salary, you're W-2, it shouldn't take more than 20-30 minutes to
Okay.
get everything reviewed. But if you have something a little bit more complex with tax returns with schedules, it could take a little bit longer, a couple hours maybe.
Okay. So, but it's
Um,
something that if you wanted to go buy a house tomorrow, if you could submit it in the morning and have your pre-approval in the afternoon or
you
something like
can,
that,
yeah,
as
yeah.
long as it wasn't more complicated. What if you want, like, what if you're shopping around for lenders? Is it true that if you get your credit pulled like all at the same time, then it won't affect your score in the same way?
It won't. It's true. Yeah, the bureaus give you an opportunity to shop for car loans, for mortgages, or for student loans.
Okay.
So you can have your credit pulled once or 100 times, and within a 15 to 45-day window, there's no to minimal impact.
Okay. But not credit cards. You can't shop around
Not
for
credit
credit
cards. No.
cards.
No.
Doesn't work the same way. Okay. I didn't know that either. I thought maybe it was just like a week or something like that, but 15 to 45 days, that's
Mm-hmm.
really good to know. Okay.
And
Um,
most people get overly worried about inquiries. I'm going to say I hear that more now than I have in, probably the last couple of years more than ever. Everyone's so worried about having their credit pulled. It's only 10% of your overall score. You're not going to lose all 10% with one pull. So don't worry.
and as a lender, you would see that and you would say, oh, they pulled their credit a few times, you know, you're going to take that into consideration when understanding their score.
If it's a lot of, if I can see they're shopping for a loan,
Mm-hmm.
like car loans are a perfect example. You go to a car dealership, they're going to pull, the F&I manager is going to pull your credit with them and with Toyota credit and Chase credit and this and that. And you're going to see, okay, that was obviously all for one account.
Mm-hmm.
But then if I see they tried to apply for a couple different store charge cards and medical cards and this and that, then you start to question their financial stability.
Mm-hmm. Okay. And so that's another thing that's a big no-no is when you're in the process of getting a mortgage is
Mm-hmm.
that you should not get any credit during that process without the explicit approval from your mortgage lender.
Yep.
So don't go out after you're trying to buy a house and then buy a car. This is the
Don't
last.
give anybody your social security number. That's really just leave it at that.
Okay. Yep. So yeah, I know that that's kind of always the horror story, right?
Mm-hmm.
When you find out that you run somebody's credit right before the closing and you find out that they just put furniture on a charge card or something like that, or yeah.
Well, don't even do it after your pre-approval too. It's not
Okay.
just I've been pre-approved, but I don't have a house under contract, because that lender may not know about it right away. Now, once we start an application to buy something, then we have like a credit alert monitor system that'll tell us your credit was pulled or you opened new credit. It doesn't tell us about a late payment or anything like that, but it will tell us about applying for or obtaining new debt.
Okay.
Then we're going to ask you questions, or it could stop at closing.
Okay. Okay. Let's talk about self-employed people, because I know I am one and I know a lot of them. So what is the difference in what you're looking for? Is there a difference in credit that's required? And then what are the documents that you need?
For the most part, there's not a difference in credit. The credit score requirements for self-employed are the same as they're not self-employed. But the amount of documentation you have to give is going to be a little bit greater because you are the business. You're not salaried. Your income can fluctuate. The lender is going to qualify you based off of not what you're actually getting with gross income, but what you're telling the IRS you're walking away with after expenses. They're going to want to see typically 2 years of tax returns. Nowadays with COVID, there's been lots of changes to lending guidelines with COVID. So now with COVID, we need not only the tax returns, but we need a year-to-date profit and loss statement. We need 3 months business bank accounts, so we can see the bank statement, so we can see that you're regularly receiving normal income. Because COVID has really changed, what is a normal income and normal revenue in business. They want to see stability. So, you're a restaurant owner and you can see over the last few months, okay, here's the revenue with takeout only, February 1st. Now we can have some limited dining, so the income hopefully goes up. But that's nothing like what you showed in your tax returns in 2019 or 2018, because that was a whole different world. So we're going to look a lot more closely at the profit and loss and the bank statements than we would on the tax returns for that type of person.
Gotcha, because the tax returns are just looking backwards.
Mm-hmm.
And do you anticipate that that like when that requirement might go away? Because if the person, I guess, remained profitable during 2020, would that be an indication that they're probably, a good lending risk?
I don't think it's going away anytime soon.
Okay.
I'm gonna speculate. They haven't said anything. This is mainly driven by Fannie Mae and Freddie Mac, and then all the other agencies have kind of followed suit. So my speculation is whenever we get to normal, whenever everything opens back up again, not that next tax year, but the year after that is when we get back to not needing profit and loss statements, not needing bank statements, just going back to show me your last year or 2 years of tax returns, and we'll calculate off of that.
And you need to have been in the same profession? Like if
your business needs to have been open for 2 years.
Okay. So like I can't be like a hairdresser for 1 year, but doing well, and then a real estate agent the next year and also doing well. That doesn't work.
No.
Okay.
But if you're a hairdresser who works at salon A and then you move to salon B and both salons give you a 1099, that's fine. That works.
Okay, perfect. So since we mentioned COVID, and we got a couple questions, I'm going to come back to those. I wrote them down. What else has changed in the lending market with COVID? I know kind of right during the shutdown, there was an availability of money to lend, but is that still an issue? Because I know like so many people were refinancing and, on the back end, I don't understand it completely, but there was like some like not enough credit to be able to extend. Can you talk about, is that still the case?
There's not a liquidity issue. In fact, in the midst of COVID, with rates being the lowest ever, my industry had the best year on record by far. So that just means lots of revenue, lots of money being made. So there's not a lack of liquidity or anything like that. What has changed? Rates have dropped down in part because of the instability at the beginning of COVID, and now predominantly from the Fed just buying trillions and trillions of mortgage-backed securities on a daily basis to keep rates low. And the Fed announced today, the 27th, January 27th, that they're going to continue to do that this year, because they don't want to stop doing it or taper off and see rates shoot up, because even with inflationary concerns, they would worry about what that would do to the economy. So rates are going to stay low this year, probably for a bulk of next year. We have seen a lot of appraisal changes with COVID.
Okay.
You know, people are not always welcome to having strangers come visit their home. Appraisers aren't always comfortable going into homes. So we've seen the ability to do desktop appraisals, where you're just an appraiser's giving an opinion of value, looking at information online. We've had people do FaceTime and Zoom appraisals, where the homeowner would just give the appraiser a tour. And there's been an expansion of appraisal waivers, where if the buyer's willing, the lender won't require an appraisal.
Okay. Yeah, I've my experience, I think Quicken, I have not known them to do an in-person appraisal at all. So since the beginning of 2020. So yeah, that's for the, I've never heard of a FaceTime appraisal, but that's really interesting. There you go. Do they make the homeowners measure for them as well?
No, I think they go off the public record.
Okay.
They're just looking at the conditions and the quality of materials at that point.
So if let's say there's a desktop or a drive-by appraisal or what have you, and it comes in low, can you then request an in-person appraisal? Like if you think that they missed something by not actually going to the property?
Yeah, that's an upgrade. You know,
Okay.
an in-person one is considered more reliable in every way. So yeah, you could do that.
Okay, so regarding mortgage approvals, Brittany just put in a question. She wants to know, this is more for let's see, how much weight is given to tax returns for someone in a salaried position? If I claim a loss on my taxes, will that affect my buying power?
If you're a salaried person, the question is, what's creating that loss? Was it a one-time thing? Were you self-employed with a loss and now you're salaried? Does that business no longer continue? If that's the case, then the lender's only going to go off your salary. They won't use the loss. But if the loss is created by something that's still ongoing and you're losing money even in spite of your W-2, then it'll be a problem.
Okay.
You may have to bring in a cosigner.
Okay. So if somebody wanted more information about that, they could contact you and you could talk to them about what they're looking to do and their background and scenario and give them advice. Okay, so it was it was a real estate loss. It was a one-time.
Oh, yeah. Then you don't have to worry about it.
The W-2s are out there are gold. They're worth their weight in gold. They're just much more reliable for the lenders. Okay, so as far as credit goes, are there things, so I have a couple questions about credit and income. Are there things that don't matter, like things that people think should matter that don't, like child support or a bankruptcy or a foreclosure, or like do they matter less than people, can you buy a house within 7 years if you've had a foreclosure, things like that. And then are there things that like just you absolutely can't work with? Like if they have this on their credit, that's just a non-starter. Let's
start with that. Delinquent or student loans that are in collections. That's a big problem. You have to get them out of collection, because the feds, they can come in and they can actually foreclose on top of somebody, even if they're making the mortgage payment on time. And that home's our collateral for the loan. So that's scary.
Okay.
Yeah. So that's a big no-no. You've got to get out of collection, do something they call rehabilitate the loan. Basically, get a payment plan and get a few months under your belt. Tax liens are a problem. You're going to have to get those under control, pay them, or get a payment plan. Beyond that, foreclosures, bankruptcies, there's waiting times after that before you can get a mortgage. And they vary from FHA to conventional. And with extenuating circumstances, the waiting times can be a little bit lower. You can have a bankruptcy, a Chapter 7 bankruptcy, and might have to wait 2 years. You can be in the middle of a Chapter 13 bankruptcy and buy right now. So the rules do vary.
Interesting. Okay. What about child support? Like if you owe child support?
If you're paying it on time, it's no problem.
Okay.
If you haven't paid it in a while and you owe it and there's an arrearage, you're going to have to start paying it on time.
Okay. So you'll have to get caught up on that.
You have to get caught up. It only shows up as a collection on your credit report if it's in collection. If you're behind and they haven't gotten a collection, then it's not going to show on your credit report, but we'll still find out about it.
Okay.
We've got our ways.
Okay. I'm sure you do.
Mm-hmm.
Okay. Let's see. So I'm going to ask you, so Sabra had a question about rent to own. So if
Mm-hmm.
I am purchasing a house rent to own, and then I'm to the point where I want to get a mortgage, can I use the rental payments that I've paid towards my down payment?
As long as you can show a paper trail of where it came from.
Okay.
And unfortunately, that paper trail is not money orders
Okay.
and money order
Right.
receipts.
Checks?
So if you pay by checks,
What
personal
about
check,
Venmo?
cashier's check, Venmo, yeah, anything with a paper trail that I can show explicitly, this payment went to this landlord, this money came from you. That's fine.
So certified checks do work?
If you can show me where the money came from to buy the certified check, yeah.
Okay.
So if you
Okay.
bought it with cash and didn't come out of your bank account, that wouldn't work because there's not a paper trail.
Okay.
You can't paper trail cash.
Okay. I remember a bunch of years ago, I had a client who was buying a house and it was coming with appliances. So she wanted to sell her current appliances. She sold them on Craigslist. And so she had these deposits in her account for the appliances that she sold. And the lender was really giving her a hard time. Like, where is this money? What did this come from? Is that still is that Patriot Act stuff? Is that still, do you still have to review like deposits and things like that?
Mm-hmm. It's they look at it now more than ever before because
Okay.
so much of your activity is right on your bank statement. I can see where you're eating, you know what your bills are. So if I see these large cash deposits and I know that you get a paycheck and it's directly deposited in your bank account, I've got to know where this money came from because you could have taken out a loan that could make it so that you couldn't repay me.
Mm-hmm.
So any money you put in your bank account, you need to paper trail. If you're selling the appliance off of Craigslist,
Mm-hmm.
you know, that's a little harder. Hopefully you get paid by check. But the biggest thing is you've got to prove ownership of what you sold, or the property, what you sold. And you sometimes have to get an appraisal of it. So cars are great examples. People sell cars all the time. You can sell a car. You can prove the transfer of ownership, and you can get a blue book value to show the value of what it was. Just make sure you get a bill of sale and your buyer pays with some sort of check, and you make a copy of that check so you can prove to your lender this money came from the sale of this asset, which was worth this.
Okay. What about retirement income or like Social Security? Can you use that towards income for a purchase?
Absolutely. Yeah.
Okay.
That's some of the easiest because it's really cut and dry.
Mm-hmm. Okay, that's great. Okay, so I also wanted to ask you, we're getting close to the end here. And I know you don't have a crystal ball, but what do you think, how do you think the mortgage market is going to look for the rest of the year? I've heard some ideas that rates could go even lower. Like what do you see out there? What might you expect to happen? What is the new administration going to do that like maybe will affect the mortgage market?
I think we're going to see rates stay relatively low through the end of the year, staying in the 2s or low 3s, so still crazy low. I don't think we're going to see the rates shoot up because the Fed isn't going to let that happen. They're going to continue to buy the mortgage-backed securities to keep the rates low. Home values, I think I saw yesterday, are projected to maybe go up another 10% nationally over the next year. Last year, they were 11% nationally up. So I think we're going to see a hot housing market. We're going to see strong mortgage market. And I don't think
we are already there.
we're already there, but I think it's going to continue.
Yeah.
And I don't think the new administration is going to have an adverse effect on any of it. I'm kind of interested to see how Yellen's appointment changes anything, hopefully for the better. I do expect that we're going to start to see some additional fair lending laws that are going to be focusing in on trying not to scrutinize against minorities. That seems to be a really big goal of the president's, and I think that's a great idea. So you may see incentive programs for people who typically could be discriminated against. And you probably will see some lenders go out of business because of fines because they were considered to be discriminating against.
Mm-hmm.
So that shakeup could happen.
Okay. Yeah. I mean, that sounds like all good stuff.
Mm-hmm.
Okay. Well, does anybody else have any questions out there? Is there anything, Matt, you think that you wanted to mention that we should have talked about?
I think we covered a lot of good stuff.
I think so too.
Yeah.
Okay, well, what about how do people, you know, oh, I think one more question I think I missed from Sabra. The closing times. Have closing times slowed down due to increase in volume, or how are they currently running for you?
For us right now, purchases are taking with about 30, 35-ish days.
Okay.
Lenders are seeing, and we are, a lot of refinance volume. So that does slow things down because all the resources are really used up for everything: appraisers, title, underwriting, processing, etc. So about 30, 35 days. Refinances are taking probably 45 to 60-ish days.
Right, because you don't really have a burning timeline for those.
Right.
Okay, well, how do people get a hold of you if they want to maybe talk about getting a mortgage this year?
You can give me a call. My number is 248-219-7552, or go to applywithadler.com.
Fantastic. Well, thanks so much. I love this conversation. Super interesting. I thought I knew there were a lot of, you blew my mind on that warrantability or the renter to owner occupied ratio for condos. That's really interesting. And then also some of the down payment related stuff. So thank you so much.
Thank you. Thanks for having me.
Okay, take care. Bye, everyone.
Bye.